two economic forces are battling for your future and your savings right now. You can feel it in rising bills, in job ads, and in headlines that promise stability and then pull the rug away. This battle is not abstract or academic for you, because every bank account and retirement plan is a battlefield where inflation or deflation will determine winners and losers. The first thing you should understand is the scale of what is at stake and why both sides have plausible claims to victory. Act 1 begins with inflation, the force most people intuitively fear because it erodes your savings and reduces purchasing power over time. You have lived through episodes where money seems to lose its meaning and prices march relentlessly upward, and that memory makes inflation emotionally powerful for you. When we talk about inflation in this decade, you have to see it as a complex mix of policy and politics, where central banks, fiscal deficits, and supply disruptions all conspire to raise prices for everyday goods and services. The story of inflation is a story about choices made by governments and firms, and how those choices ripple through the economy to affect your life. One of the most important inflationary forces this century has been enormous money creation by central banks and governments. After 2008, and again after 2020, with more than $20 trillion effectively created or mobilized since the global financial crisis. You can picture massive balance sheets expanding as central banks bought bonds, financed deficits, and flooded markets with liquidity to prevent financial collapse. That liquidity had consequences. And when supply could not instantly match new demand, the result was price pressures that landed squarely on consumers, savers, and businesses alike. The simple fact is that when you put a lot of money into an economy without a matching increase in goods and services, prices tend to move up and your savings buy less. Government debt amplifies inflationary pressure because when governments spend without raising taxes, you face two choices: higher taxes later or more money printing now. And the latter often looks politically easier. You should imagine a generation of policymakers balancing between immediate political demands and long-term fiscal consequences, while the public expects social services to remain intact. Demographics are also part of this inflation story because retirees tend to spend differently, and a large retiring baby boomer cohort places strains on pensions, healthcare, and public finances that often force governments to monetize liabilities. For you, that means an aging population can be an inflationary tailwind in public spending and medical costs. Supply constraints and the energy transition created more inflationary pressure than many economists expected, particularly after the pandemic disrupted global supply chains and energy markets. You can see factories paused, shipping containers stranded, and the sudden cost of moving goods spiking prices for food, energy, and durable goods. The transition to green energy also carries short-term costs because building new infrastructure, rewiring grids, and paying for rare minerals creates input price increases that appear as inflation. For you, that means that even policies designed for long-term sustainability may raise costs in the short run and feed inflationary narratives. What happened next will shock you if you only read headlines, because the 2021 to 22 period was when inflation seemed to decisively win the argument, moving from theory into your grocery cart and heating bills. You experienced sharp price increases, and central banks were forced to respond with the steepest interest rate hikes in decades to try and cool demand. In that moment, many believed the era of low inflation was over and that your long-term savings needed a new defense. But here is where it gets interesting. Those rate hikes themselves set new dynamics in motion that would re-energize deflationary forces later on. Act 2 introduces deflation, the quieter but equally powerful force that can make prices fall and jobs disappear when productivity rises faster than demand. You might think deflation sounds good if prices drop, but for savers and workers it can be damaging because falling prices often mean falling wages and collapsing asset values. Deflationary pressure is not the opposite of inflation in a moral sense. It is a different economic equilibrium that rewards creditors and punishes borrowers, reshapes industries, and can lead to prolonged stagnation if not managed carefully for you. It is crucial to recognize how technological advances and demographic shifts can steadily push prices downward over time. Technology deflation has been relentless in many sectors because computing power and digital distribution drive costs down for products and services at an astonishing pace. You can buy far more computing horsepower today than you could 10 years ago for a tiny fraction of the price, and that general trend exerts downward pressure on prices across many industries. When productivity improves through technology, companies can produce the same output with fewer inputs, and that competitive force often leads to lower consumer prices and thinner margins. For you, that means the march of technology is a steady deflationary undercurrent that central banks struggle to measure and respond to. Artificial intelligence and automation accelerated deflationary pressures by promising massive productivity gains across services and manufacturing at a scale previously unimaginable. You are now seeing software replace human labor in tasks that once required entire offices, which lowers labor costs and can reduce price levels for many services. That productivity threatens to displace workers even as it increases output, creating a tension where cheaper goods coexist with social instability and weak wage growth. For you, the important takeaway is that AI-driven deflation can be fast and deep, and it forces policymakers to rethink labor markets and social safety nets. Demographics can push toward deflation as well, because aging societies and falling birth rates often mean lower aggregate demand over the long term. You should imagine a society where fewer young people are entering the workforce and consumption patterns shift toward more healthcare and less durable spending, with less robust demand. Businesses compete harder, prices stabilize or fall, and economies can enter slow-motion contraction that feels like deflation. For you, this demographic reality is especially relevant if you live in advanced economies where population growth is stagnating or declining. Debt deflation is a less visible but profound mechanism where the burden of existing debts forces consumers and businesses to cut spending, amplifying price declines. You must understand that when debt burdens rise relative to income, entities focus on repaying or restructuring liabilities rather than buying new goods or services. That deleveraging process reduces demand and pushes prices lower, which in turn increases the real value of debt and can trigger a vicious cycle of further deflation. For you, the lesson is stark. Debt dynamics can flip an economy from growth into deflation without dramatic external shocks. To understand the stakes, consider Japan over the last 3 decades where massive money creation did not produce runaway inflation, but instead coincided with persistent low growth and price stability. You might expect large balance sheets to produce inflation, but Japan's experience shows that cultural, structural, and demographic factors can convert that liquidity into stagnation instead. Japanese policymakers tried repeated stimulus, and yet deflationary forces kept reasserting themselves, creating a template that economists still debate as an example of how printing money does not guarantee inflation. For you, Japan serves as a warning that money supply is only one variable among many in this battle. On the opposite extreme, history offers the Weimar Republic as a lesson in how money printing can collapse an economy through hyperinflation when public confidence evaporates. You can see the terrifying speed at which prices spiraled out of control when fiscal imbalances and political breakdown destroyed trust in the currency. Weimar is the nightmare inflation case that shows just how quickly savings can be obliterated when everyone rushes to spend money before it loses value. For you, that history is a reminder that both extremes are possible, and that confidence is a fragile but decisive component of monetary stability. Act 3 focuses on the center of our present decade, where inflation and deflation are engaged in a tense stalemate, producing confusing signals for investors, policymakers, and consumers. You witnessed inflation spikes followed by falling commodity prices and central banks shifting tone toward easing or pausing rate hikes as growth softened. The result is a battleground in which both narratives have won skirmishes, and both remain plausible for the decade ahead. For you, that means certainty about the economic future is unrealistic, and the smarter choice is to understand the mechanisms that could tip the balance one way or another. One of the most dangerous possibilities emerging from this battle is stagflation, a scenario where high inflation combines with weak growth and high unemployment to create something close to economic misery. You need to remember the 1970s era when energy shocks and policy mistakes produced stagnant output alongside soaring prices, and policy options were painfully limited. If stagflation returns, traditional playbooks fail, because neither easy money nor austerity clearly solves the dual problem of rising prices and collapsing demand. For you, the specter of stagflation means that preparing only for inflation or only for deflation could leave you exposed to severe financial pain. Now consider what this means for investments, because everything you own or hope to own depends on which macro force ends up dominant. You should know that inflation and deflation create entirely different optimum portfolios, and choosing the wrong stance can erode decades of savings in a few years. This is why investors' pension funds and everyday savers are debating gold, bonds, stocks, and real assets with renewed intensity, attempting to position themselves for scenarios that still feel wildly uncertain. For you, the smart step is to learn how each asset behaves under different macro outcomes so that you can hedge appropriately. In an inflation-dominant world, real assets like land, commodities, and inflation-linked bonds tend to perform better because their values move with or above the general price level. You have to recognize that physical assets often have intrinsic usefulness that keeps them relevant even when money loses purchasing power. Gold retains symbolic value and can act as an insurance policy against catastrophic currency debasement, while commodities benefit directly from price rises and scarcity concerns. For you, allocating some portion of wealth to real assets can serve as a hedge against sustained inflationary trends. If deflation becomes the dominant force, however, traditional safe havens like long-term government bonds and high-quality cash instruments can outperform, because nominal yields may become stable, while real yields rise as prices fall. You should consider that in a deflationary context, the purchasing power of fixed income can increase as general price levels decline. High-quality companies with strong balance sheets and pricing power may survive and even thrive, but many cyclical businesses will struggle under falling demand and intense price competition. For you, this means a bias toward balance, sheet strength, and low leverage if deflationary pressures look likely to persist. Stocks occupy a middle ground where successful companies can still grow earnings despite inflation or deflation, but their valuations will shift dramatically under each scenario depending on interest rates and growth expectations. You must understand that higher rates typically compress equity valuations while lower rates expand them. And inflation complicates both because nominal earnings can mislead about real purchasing power. For you, active selection and diversification across sectors matters because technology and healthcare may behave differently than energy and finance in either macro regime. The critical skill is to think about cash flow resilience and margin durability, rather than relying on historical correlations that might break under new structural forces. Real assets versus financial assets is more than a semantic debate, because each represents a different claim on the future of real production or on monetary promises. You should think of real assets as claims on physical productivity, while financial assets are claims on promises that depend on policy credibility and counterparty solvency. When confidence is strong, financial assets can explode in value. But when confidence collapses, real assets can become safer anchors for you. This duality means that building a resilient portfolio is more about optionality and adaptability than betting all your chips on one deterministic forecast. Economists are divided because the same data can support both narratives and because human behavior, policy responses, and technological surprises change the rules. You should not be surprised that forecasts differ dramatically because models are simplifications and the real economy is messy, adaptive, and full of feedback loops. The lack of consensus is actually a signal that humility is warranted when making long-term financial commitments. For you, the right stance is not rigid certainty, but a prepared mindset that can pivot as new evidence arrives and as the balance of forces shifts. The next decade will be decisive because demographic change, technological adoption, and policy legacies will evolve into compounding effects that lock in certain trajectories. You should watch key indicators like real wages, productivity metrics, debt to GDP ratios, credit spreads, and central bank balance sheet movements to understand where the momentum lies. Small changes today compound into large outcomes over time, and the policy choices made by governments and central banks will shape the distribution of gains and losses across society. For you, being vigilant and informed offers the highest probability of navigating uncertainties effectively. Policy risk is perhaps the single largest wildcard because political responses to pain can create unintended consequences that either exacerbate or alleviate inflationary and deflationary pressures. You must consider that democratic politics can lead to short-term solutions that produce long-term liabilities, and that those liabilities influence the economic regime you face. Trade tensions, fiscal populism, and geopolitical shocks can all tip the balance quickly, just as they did during the pandemic and energy crises. For you, understanding the political context is as important as watching monetary aggregates when forming expectations about future prices. So what should you do right now with your personal finances, given the enormous uncertainty and the credible arguments on both sides of the debate? You should prioritize diversification, liquidity, and reducing excessive leverage because those three principles preserve optionality in either an inflationary or deflationary outcome. Maintain exposure to real assets that can hedge inflation, but also keep high-quality fixed income and cash, like reserves to benefit if deflation or recession hits. For you, practical steps include trimming speculative leverage, favoring businesses with pricing power and low debt, and keeping a modest allocation to hedge instruments that perform across different regimes. We should also acknowledge that some risks are systemic and require broader societal solutions that you cannot individually engineer away, such as pension shortfalls, healthcare inflation, and geopolitical fragmentation. You should advocate for better policy design and support institutions that promote sustainable fiscal frameworks. Because individual choices have limits without systemic stability, collective action and smart governance can reduce tail risks like runaway inflation or prolonged deflationary depression, For you, engagement and informed civic participation are part of a responsible response to macroeconomic uncertainty, because sound policy amplifies the effectiveness of prudent personal decisions. Remember that the worst-case scenario is stagflation, where you could face both high prices and weak wages, creating a squeeze that is politically volatile and economically damaging to many households. You should prepare for that outcome by holding assets with real cash flow, maintaining emergency liquidity, and avoiding interest rate-sensitive leverage that could break under stress. Stagflation turns conventional wisdom on its head and punishes those who assume stable correlations between stocks, bonds, and commodities. For you, survival in such a regime depends on flexibility, careful risk management, and the humility to accept unpredictable outcomes. At the same time, do not let fear paralyze you, because opportunities emerge from disorder and uncertainty if you can think long-term and act selectively. You should study secular themes like energy transition, AI productivity gains, and demographic-driven services that may outperform regardless of general price levels. Investors who identify structural winners while protecting against macro shocks will likely outperform those who chase short-term certainties. For you, cultivating patience and selective conviction is a practical strategy that balances risk and reward across plausible futures. Economies are messy, people are adaptive, and history offers warnings but not certainties, so humility must accompany any confident forecast you hear from pundits or analysts. You should treat narratives as tools for thinking, not as decrees to follow without question, because the world often surprises those who expect it to behave like past models. This means constantly updating your beliefs as new data arrives and as policy responses reveal themselves in the months and years ahead. For you, intellectual flexibility combined with disciplined financial preparation is the best hedge against the battle between inflation and deflation. In the end, the fight between inflation and deflation is not merely about prices, but about power, trust, and the architecture of modern economies that decides who benefits and who loses. You will live through the consequences, and the next decade will crystallize the winners from the losers based on decisions made by firms, consumers, and governments now. So ask yourself which scenario you are prepared for, and take concrete steps to hold optionality, reduce vulnerability, and lean into structural opportunities where possible. The future is not predetermined, and your actions matter in shaping whether inflation, deflation, or the worst case stagflation will dominate the lives you care about. If this discussion gave you a new perspective, then your next step is simple but powerful. Subscribe and keep learning, because the economic contest of the coming decade will reward informed, adaptable people. You should share this video with friends and family who are making important financial and life decisions influenced by macro realities. The tug of war between inflation and deflation will continue to unfold in ways we cannot fully predict, but your preparedness and curiosity will determine how you fare. If this gave you a new perspective, hit subscribe.